President Messer, thanks for joining us. I can't hear President Messer. Is it just me?
Steve, can you hear me now?
Up, there you go. That's great. Thanks very much. President Messer, I want to just begin with the most pressing issue right now. The Russian invasion of Ukraine, the sanctions that have been put on Russia. How does this alter at all your outlook for the U.S. economy, the global economy, and Fed policy?
Yeah, I mean, the task before the Fed now is to remove accommodation at the pace necessary to bring inflation under control and sustain the expansion in economic activity and healthy labor markets. So it's really critically important to get that inflation under control for both parts of the mandate. The situation in Ukraine certainly adds uncertainty to the economic outlook. Of course, our first thoughts have to be with the Ukrainian people who are having to deal with a tragic situation. But the uncertainty about the economic outlook doesn't change the need to get inflation under control in the U.S. And in fact, it actually adds upside risk that high inflation might continue, and that makes it even more important to take actions, for the Fed to take the actions we can and do what we can with both our policy tools to control inflation. So, the potential here is that those large rises we're already seeing in energy and commodity prices and potentially global supply chain issues continuing for longer, it really increases the risk of high inflation becoming embedded in the U.S. because it could lead to higher long-run inflation expectations. So that's why it's still critically important that the Fed does what it can with its policy tools to get inflation under control.
That's kind of the way I've been thinking it through, which is that you have this huge impulse of inflation coming from this war, higher oil prices, higher commodity prices, as you said, worse supply chain problems. And yet yesterday, Fed Chairman Powell suggested that all of this means we ought to go a little bit slower and steadier, and he ruled out 50 basis points. It sounds to me like you made an argument right there for going 50 and doing more as soon as possible.
No, I mean, I guess my view is, we are on a path of removing accommodation, and starting with 25, followed by further increases in coming months, I think puts us in a good position. Now, we'll have more information in the second half of the year about the effect of the situation in Ukraine for the medium run outlook for the U.S. It certainly poses some downside risk to growth. But again, those assessments might be a consideration in determining the appropriate pace at which to remove accommodation later in the year. But it certainly doesn't change the need for taking action using both our interest rate tool and our balance sheet tool to remove the emergency accommodation that was needed earlier in the pandemic, which just is not needed now and really is counterproductive to sustaining the recovery. So I think we need to be, thoughtful about the situation in Ukraine. We certainly have to think about the implications of it for the U.S. economy, but the strength in the U.S. underlying demand, the imbalances between demand and supply, all point to being deliberate about removing accommodation to put ourselves in a better position and getting inflation under control. And I expect the Fed will be able to do that without, leading to recession in the U.S. because the underlying economy is so strong, because labor markets are considerably tight. And I think we have some scope to do it in a thoughtful way, but do take the actions we need to bring inflation under control.